OpenAI's trillion-dollar IPO, the biggest wealth transfer in tech history. The official story. OpenAI is preparing to go public. CFO Sarah Friar told CNBC on April 8 that the company will reserve a portion of its IPO shares for retail investors, a move she framed as democratizing access to one of the most anticipated tech offerings in history. The company, valued at $852 billion after its record-breaking $122 billion funding round, could seek a valuation of up to $1 trillion when it lists, potentially in the second half of 2026. Friar called it good hygiene for a company of OpenAI's size to look and feel and act like a public company. What's actually happening? Let me tell you what good hygiene actually means in this context. It means Sam Altman needs an exit. Not for himself, he famously owns no equity, but for the web of investors, vendors, and circular financing partners who have poured over $64 billion into OpenAI and need a liquid market to realize returns on what is, by any honest accounting, the most aggressively loss-making enterprise in the history of capitalism. Here are the numbers OpenAI does not want you to focus on. The company projects a $14 billion loss in 2026 alone. Annual cash burn is expected to rise to $57 billion by 2027. Cumulative losses are projected to exceed $200 billion before the company reaches positive cash flow, which internal projections place somewhere around 2029 or 2030. The company has committed to spending approximately $600 billion over 5 years, and $1.4 trillion on data center infrastructure through 2033. Meanwhile, revenue growth is slowing. OpenAI hit $25 billion in annualized revenue by the end of February 2026, up from $21.4 billion at year-end 2025. That is growth, yes, but the rate of growth is decelerating even as spending commitments are accelerating exponentially. This is the financial profile of a company that burns more cash the bigger it gets. And here is the part that should make every retail investor pause. OpenAI's own CFO does not think the company is ready for an IPO. Sarah Friar has privately told colleagues that the 2026 timeline is aggressive, that she is unsure whether revenue growth will support the company's spending commitments, and that the risks from those commitments are material. She no longer reports to Sam Altman. That reporting change happened in August 2025, and Altman has reportedly been excluding her from investor meetings. When the person whose literal job is to manage a company's finances is being sidelined while the CEO pushes for a public listing, that is not good hygiene. That is a red flag the size of a billboard. There is also the small matter of OpenAI's corporate metamorphosis. The company was founded as a non-profit in 2015 with the explicit mission of ensuring artificial general intelligence benefits all of humanity. It converted to a capped profit structure in 2019, then in 2025 began the process of converting to a fully for-profit public benefit corporation. Each transformation has moved farther from the original mission and closer to a structure that can support an IPO. The non-profit board that was supposed to provide oversight, the same board that briefly fired Altman in November 2023 before bringing him back, has been progressively defanged. The people who were supposed to say no have been replaced by the people who need to say yes. The competitive landscape makes the timing even more precarious. Anthropic's revenue run rate has surpassed OpenAI's for the first time, reaching $30 billion compared to OpenAI's $25 billion. Anthropic is growing 3 times faster. Google's Gemini models are closing the capability gap. Meta's open-source Llama models are eating into OpenAI's developer ecosystem. And Chinese competitors like DeepSeek have demonstrated that competitive large language models can be built for a fraction of OpenAI's costs. Altman needs to go public before the market realizes that OpenAI's moat is not as deep as its spending is wide. The evidence trail. Follow the money backward and the circular financing structure becomes impossible to ignore. Bloomberg published a detailed investigation showing how cloud companies and chipmakers fund AI developers who then become their largest customers. Amazon invested $50 billion in OpenAI while OpenAI committed to spend over $100 billion back on Amazon Web Services. Nvidia contributed $30 billion, primarily in compute capacity, dedicated inference and training systems, not liquid capital, with commitments for 3 gigawatts of dedicated inference capacity and 2 gigawatts of training on Vera Rubin systems. These are not investments in the traditional sense. They are vendor financing arrangements dressed up as equity rounds. When Nvidia announced its $100 billion investment commitment to OpenAI in September 2025, analysts immediately drew comparisons to the telecom bubble of the late 1990s, where equipment makers like Nortel and Lucid lent money to their own customers so those customers could buy their products. The cycle worked beautifully until it didn't. Nortel went from a market cap of $398 billion to bankruptcy. Lucid followed. The pattern is structurally identical. The $122 billion funding round that valued OpenAI at $852 billion was not a traditional venture capital round. As SASTR detailed, it was a combination of vendor deals, contingent capital, and a guaranteed return that the company arguably cannot afford. When your largest investors are also your largest suppliers, and your revenue ultimately flows back to them, you do not have a valuation. You have a hall of mirrors. Why this framing serves them? Altman needs the IPO for 3 reasons. First, early investors like Microsoft, Thrive Capital, and Khosla Ventures need liquidity. They have been patient, but private market positions in a company burning $14 billion a year are only valuable if there is a public market to sell into. Second, the circular financing partners, Amazon, Nvidia, and others, need OpenAI to maintain its valuation to justify their own capital allocation decisions to shareholders. If OpenAI's implied valuation drops, it raises uncomfortable questions about the billions these companies have booked as strategic investments. Third, Altman needs the narrative momentum. A $1 trillion IPO cements OpenAI as the defining company of the AI era, which justifies the spending commitments, which justifies the valuation, which justifies the IPO. It is a perpetual motion machine of narrative. The retail investor allocation is the most telling detail. In OpenAI's recent private round, the company set out to raise $1 billion from individual investors through private placements with JP Morgan, Morgan Stanley, and Goldman Sachs. They raised $3 billion, 3 times their target. Friar presented this as proof of strong retail demand. But what it actually demonstrates is that Wall Street's most sophisticated distribution machines can sell virtually anything to individual investors when the story is compelling enough. And the story of OpenAI, the company that built ChatGPT, the company that might build artificial general intelligence, the company that Sam Altman says will reshape civilization, is perhaps the most compelling sales pitch in financial history. Historically, when companies go out of their way to allocate IPO shares to retail investors, it is not because they want to democratize wealth. It is because institutional investors, the funds that do deep due diligence, that model out cash flows, that price risk professionally, are not willing to pay the price the company wants. Retail investors, driven by brand recognition and FOMO, will. Facebook's IPO in 2012 is the canonical example. Retail investors piled in at $38, the stock dropped to $17 within months, and institutions who had passed on the IPO bought at the bottom. The pattern repeats because the incentives never change. What happens next? Consider the SpaceX comparison, because Wall Street is already making it. SpaceX is reportedly planning its own IPO roadshow as early as June 2026. SpaceX actually generates profit. SpaceX has a near monopoly on commercial launch. SpaceX has government contracts worth billions. OpenAI has none of these things. What OpenAI has is a brand, a burn rate, and a CEO who has mastered the art of making the future feel inevitable. That is a powerful combination in a bull market. It is a devastating one in a correction. The most likely scenario is that OpenAI files confidentially with the SEC in the second half of 2026, prices the IPO somewhere between $800 billion and $1 trillion, and allocates a meaningful percentage to retail investors through the same banking syndicate that already demonstrated it can move $3 billion in private placements. The stock will likely pop on day one, because that is what happens when you combine the most recognized AI brand in the world with a carefully managed supply of shares. But the fundamental math has not changed. OpenAI will still be losing $14 billion a year, growing into even larger losses, competing against Anthropic, which is now growing 3 times faster with a $30 billion revenue run rate, and locked into spending commitments that its own CFO has questioned. The company expects to spend $121 billion on computing power for AI research in 2028 alone, meaning it would burn through $85 billion that year even after nearly doubling sales. Losses of this scale would surpass those of almost any public company in recorded history. The Bank of England has already warned about the growing risks of a global market correction due to possible overvaluation of leading AI tech firms. A top economist quoted by Fortune said 3 out of 4 conditions for a bubble are met, the missing condition being a wave of IPOs and fraud. An OpenAI IPO would check that box. Meanwhile, Anthropic's revenue has surpassed OpenAI's for the first time, with its own IPO potentially coming as early as October 2026. If both companies go public within months of each other, they will be competing not just for AI customers but for the same pool of investor capital, potentially triggering the kind of competitive repricing that neither company's valuation can survive. The deeper risk is structural. If OpenAI's IPO prices at $1 trillion and the stock subsequently declines, as the financial fundamentals suggested eventually must, the collateral damage extends far beyond retail portfolios. Amazon's $50 billion investment, Nvidia's $30 billion in compute commitments, Microsoft's cumulative $13 billion, all of these are marked at valuations derived from OpenAI's latest round. A meaningful decline in OpenAI's public market price would force write-downs across some of the largest balance sheets in technology. This is why the circular financing structure is not just a curiosity. It is a systemic risk. The same companies that are supposed to be independent validators of OpenAI's value are financially dependent on that value being maintained. What you should do about it. If you are a retail investor being offered OpenAI shares, ask yourself one question: why are they offering them to you? In every previous tech IPO where retail allocation was emphasized, the answer was the same: institutional investors saw risks that retail investors did not. That does not mean OpenAI's stock will not go up. It might go up a lot in the short term. But the company's own CFO is telling you, as clearly as corporate communications allow, that the financial foundation is not ready to support a public listing. When the person who counts the money says the money does not add up, believe her. If you want exposure to AI, consider the companies that are actually profitable from AI, the hyperscalers generating $451 billion in operating cash flow, the semiconductor companies with real margins, the enterprise software firms embedding AI into existing revenue streams. The future of AI is real. The question is whether OpenAI's valuation reflects that future or exploits it.